All right, so this will be like the part 5 of our series on trading in line with the institutional order flow. We've been able to define some terms. We've looked at what an order block is, what an order flow is, or an institutional order flow. We've been able to look at what a breaker is, and we tried breaking it down, looking at what price action or how price action behaves. Then we went down and looked at our entry on the 15 minutes. If you remember, this strategy looks at the trend of the 4 hours. Then we look for our entry on the 15 minutes. We discussed our entry triggers, which include looking out for or identifying the institutional order flow, which would have been done on the 4 hours. Thereafter, we would want to know what price is doing at certain key levels. And the key levels for this strategy, at least for what we've covered so far, is yesterday high and yesterday low. Then went ahead to enumerate what we intend to see at those points. What are the price actions happening at those points? We would like to see divergence. We would like to see shark fin, which is perhaps a sign of the price giving us a fake move. Then we want to see the last step broken, which is just another name for a breaker, but this time on the 15 minutes. If you don't understand any of these terms, please go watch the last 4 videos. I can guarantee it will be worth your time. Now, so how do we ensure we don't spend the whole day in front of the chart looking out for breakers, watching out for our entries on the 15 minutes, especially after we've been able to identify the trend? Most times when we identify the trend, that on the 4 hours, the trend could continue for 2 weeks or thereabout, right? So if we catch a trend, we could remain in that trend for 2 weeks. I appreciate the fact that price, consolidates for more time than it actually trends, right? But if we're able to catch the trend, then we could remain in that trend for like 2 weeks or even more. Like we can see presently, we've been buying Euro AUD since last month. We bought Euro USD2 and we started selling some days back. Now, so I've been able to identify my institutional order flow, for instance, on Euro USD. Let's call up EU here. So let's say we've been able to establish our institutional order flow on the 4 hours on EU, right? And we discovered the institutional order flow to be bearish, right? So after the breaker, like we enumerated yesterday, after the breaker, we became sellers, right? So we became sellers after price broke beneath this box. We became sellers, right? Notice how price has retested. I think it was yesterday's webinar, I stated clearly that we should be looking for a sell if price retests this breaker. I remember I stated that very, very clearly. So if you actually took out time to look at the preview yesterday, I will be happy to get your feedback if you caught this. Price has given us 283 pips thereafter. I remember vividly saying this, right? So this was our breaker. Price broke beneath it. We were sellers upon a retest, right? And price was making a second retest for these, and I was saying that we should be looking for sales. I remember marking up some areas we expect price to get to previous swing highs. Now, so having discovered that the institutional order flow for now is bearish, what should I do as a retail trader? should I just go down to 15 minutes and spend the whole day waiting for my entry? Or what else can I do? How can I maximize my time and ensure that I give room for my leisure, my pleasure, my family, and some other things, right? How can I ensure that I'm not, stuck on my screen, right? So I'm going to be introducing the concept of kill zones, right? Um, kill zones are certain time of the day when price would usually move the most. Now note, it doesn't mean that price moves the most all of the time, but price will usually move the most at about this time of the day. Now I'm going to be using this chart here for the sake of proper illustration, right? So what we have here, the green box, the green line here denotes the Asian session, right? The red denotes London Q zone, London's Q zone, and the blue denotes the New York Q zone. I'll use a different chart to illustrate this even further, right? So for this, we have the blue standing for the Asian section. We'll have the Asian box right there. Then we have the red line denoting the Q zone for London. And we have the green box denoting the Q zone for New York. Remember what we say Q zones are. They are usually time range within a session that usually begins or see massive movement in price action if price would move, right? On days that price would usually move. So you see the commencement of the movement around that time, and sometime it could actually end. The movement could actually come to a grind at the close of those sessions. So we have on our screen presently GU. I want to go back a little and let's see how GU has played with respect to the kill zone. All right, so today is the 17th of March. Notice how this downward trend actually began somewhat, during the London kill zone, I beg your pardon. That's the red line there, right? So if you had missed your sell entry here and you're a skillful trader, you would have found it difficult to go into that sell thereafter, because you would most likely want to put your stop loss above the recent swing high. And that will mean your stop loss will be too high and your risk to reward ratio might not be in your favor. So you maybe you could have actually missed this trade. Now, the previous day, 16th, GU didn't really move as much as it did today, but you could notice that there are opportunities also during the London Q zone and maybe a little during the New York Q zone, but 16th wasn't, a good example. Notice how GU began to make a downward move somewhat during the New York, right? So you could have caught a sell at the beginning of the Q zone in New York and a buy at London. So depending on your order flow, if our institutional order flow is bearish, remember, we wouldn't have been in this buy. We would be looking for an opportunity to sell and sell alone from our institutional order flow. Let's see what 4 hours look like yeah, sure, fine. So when price broke beneath our breaker here, right here, we would have been looking for sell opportunities and will remain in this sell until we get another breaker in the opposite direction. Our bias will still be a sell. So on the 15 minutes, we would have been looking for sells only on GU basically, right? So notice that price actually began the downward move or sustained the downward move somewhat during the New York session, which is delineated by this green box here, line. Now notice the downward move also started on the 12th around London, right? You could have caught the sell here and 299 pips or thereabout in the kitty. 11th, not so much, right? So institutional order flow is bearish. Wouldn't have attempted to buy, but the sell came up during the what? The Q zone of New York, right? The sell started during the Q zone of New York. Let's see if we can modify this a little. I go to, let's see, find a way of making this go back a little further. Okay, right, so notice on the 10th, price actually started making its downward move during the London Q zone, right about here. And what do you notice on the 9th? There was a massive push to the upside on the 9th, and that occurred during the London as at, let's see what happened. 9th, where were we? What was the order flow on the 9th? Order flow on 9th, okay, 9th was still bullish, right? We started becoming bearish on the 10th cum 11. So 9th will still have been bullish, right? Because price hadn't broken the order block here, right? So at this point, we would have been thinking of buying. On the 9th, we would have been buyers, we would have been looking for an opportunity to go long. And notice that that opportunity came during the London Q zone, right? During the London Q zone. Notice the previous day, another opportunity to buy came during the London Q zone, right? It gave us another opportunity to buy during the New York Q zone, 61 pips, right? And I could do this over and over and over on several pairs. Let's look at EU. Let's look at EU and see how this plays out in EU. So EU presently on the 4 hours, like we discovered earlier, is bearish. And the bearish bias started from the 12th of March, right? So on 15 minutes time frame, notice today, you could have been in this sell from the very beginning of London, and it was maintained all through the session, right? The sell-off here, you could have caught this sell from New York, right? Leave out this. This happened in between London Q zone and New York Q zone. And the easiest way, one of the easiest ways of throwing your money in Forex, of losing your money, wasting your account, is trying to catch every peak in the market. But imagine if you caught this sell at the beginning of New York. You had over 100 pips you could have gone home with, right? So notice that massive movements happening around. You could have caught this sell on the beginning of London, or you could have caught this somewhere in New York. Notice this too. We had a massive sell-off coming during the London Q zone, and it gave another opportunity of the open day price in the New York Q zone. So I believe I've been able to demonstrate that there are certain times of the day that price has been observed to make several movements. And it's only wise to restrict your trading to those time frames, those periods, so you don't have to spend the whole day in front of your chart. What it does is that it reduces your screen time. It helps you maximize your time properly. Your screen time is reduced, then you don't start making up setups that don't exist. You have a better work-life balance. For those of us who trade full-time, you could have your time for some other religious activities, recreational activities, or whatever you want to use your time for, right? So imagine spending, let's say, 4 hours London, 4 hours New York. You have 2 solid hours in between to take a nap, stretch, right? Retail traders are people who need the gym a lot, right? So you have a healthy work-life balance, right? Use that time for other recreational things. Read a novel, read a book, do something, take a nap, right? So you don't spend the whole time just looking at the charts, and I can guarantee you have a better trading experience doing that. Just notice EU, see the movements, right? London, notice another London move, right? Notice New York for the sell, London, right? So what are the time zones? What time frame or time range basically? I am presently GMT +1. My MT4 time is an hour ahead of my present time, my local time, right? So Q zones, from what we could see here, 7 a.m. and that will be 6 a.m. my local time, and that is 2 hours before London. Let's look that up. Let's look that up. So Forex time zone converters, right? Forex time zone converter. All right, so presently I'm in GMT +1. I'm in GMT +1. So where is that now? Africa. Blah, blah, blah. Yep, somewhere there, right? So GMT +1. London opens at 9 a.m. as at now, right? So if I go back to the chart, I have 2 hours before London opens. So if I'm up 2 hours before London opens, that's my Q zone, right? I'm up 2 hours before London opens. I remain in the market from 7, my MT4 time, 7 a.m. to 11 a.m. That's 4 hours, right? In 4 hours time, if all things are okay, I should be in profit enough to have hit my first target of 1:2, or I should be significantly in profit enough to want to break even and take a nap, right? Or I could decide to sit down and monitor my trade in cases where I have an entry. There are some days the market won't give you an entry. You simply just take a walk, come back in the Q zone of New York to see if the market will give you an entry, right? So three things can happen. It's either I have an entry and price has moved in such a way that I could either break even or take partials. Second option, I don't have any entry. And after the Q zone, I'm taking a walk, take 2 hours rest, come back during New York to see if price action will give me an entry, right? So I have 4 hours, right? 7 a.m., my MT4 time, down to 11, 4 hours. Then from 11 down to 1, 2 hours for rest. 2 hours for rest, off screen time, stretch your body time, nap time. And I'm back at 1 down to 5, another 4 hours. Depending on your trading strategy, if you have a trading plan, it's possible that you might not return back to the charts until the following morning. If you had met your daily PIP goal, if you've met your goal, depending on your trading plan, there is no reason being in front of your charts during New York. You could as well have met your target during the London Q zone and you simply take a walk, right? So how do we do this? I usually will advise that Euro pairs, EUR pairs, and GBP pairs, you look for entries on these two pairs during the London Q zone, right? That way you could focus on just some few pairs, Euro pairs and GBP pairs during the London Q zone. Then you look at USD pairs, USD and CAD pairs, USD and CAD pairs during the New York Q zone. Now, obviously, there will be some pairs that could give you entries during the London Q zone and also during the New York Q zone. Example, Euro USD, because it has both Euro and USD. You have Euro CAD, you have GBP USD, and of course you have GBP CAD. This could give you entries on any of the time, the sessions, right? The trading sessions. Now, other ones like EA, EN, I'll want to see an entry during London. And if it doesn't give me an entry during London, when I'm coming back in New York, my attention is shifting to AUD CAD, you know, things like that. AUD USD. Now, the reason is that it's easier to concentrate on 857 pairs, scanning through them, than scanning through 28 pairs at the same time, right? So if you've had your MT4 programmed in such a way that you'd spend, you know, the first 4 hours looking out for Euro USD, Euro CAD, and the likes, then it makes things easy. Now, you'll notice that because of coronavirus, and of course, the year 2020 started with the blast. We had the Trump, the US, and Soleimani issue. Then came coronavirus and so many things. So the market has been highly volatile. In fact, it's been driven basically by fundamentals, right? Aside that, and that is not the usual behavior of the market, right? pairs have been bursting their ADRs, you know, they've not been respecting the average day, the usual ADRs that they are known for. But I assume that things will simmer down and perhaps begin to stabilize sometime during the second quarter of the year. And in those instances, I expect that when I enter a trade during the Q zones, for the ones I'll be entering during London, I should be looking at 2/3 of the ADR, especially in instances where the Asian session isn't overblown, meaning that the Asian session hasn't done more than 50 pips. And I'll be looking at 2/3 of the average daily range of that pair. Now, to put it in context, pairs like EU, right, I'll be looking for a take profit of between 25 and 30 pips. I should be happy with that if I'm scalping. That's if I'm scalping. Ditto for Eurocard and the likes. For the Euro pairs, EA and EN, I should be looking for between 40 and 50 pips. That should make me happy during the London Q zone. I should also state here that this depends on your trading plan, right? Now, if you've been following our videos, we also have that you could do a risk to reward ratio of 1:2. At minimum, you should expect 1:2, right? So whichever fits into your trading plan, these are just guidelines. Remember, I'm no financial expert. I'm not a Forex guru. I just found a system that works for me and makes me profitable consistently. You could develop your own strategy, your own style. But these are just some observations from the market, right? So I don't know if any of us online has any question to add. I'll quickly go to the next issue I want to pick up before we call it a day. So I believe you understand kill zones. It helps you frame out your time. If you're in US or some other time zones where London is not too comfortable to trade, then you could trade during the Asian session. I don't have expertise with regards to the Asian session, but London, New York, 4 hours each, starting from for London, maybe an hour or two before London opens, or just make it an hour before London opens, 3 hours into London, 4 hours, and you're done. You go take a nap, go do whatever you want to do with your time, and come back. All right. Any questions? Someone's mic seems to be on. Yeah, you wanted to say something?
Yeah, I wanted to ask you a question.
Go ahead, please.
Okay, talking about the Q zones.
Yeah.
And the institutional order flow method of trading.
Yep.
Okay, so because I know initially you told us that when I joined the meeting late, so you may have talked about it earlier. I don't know. You talked about getting our entries in the 15 minutes, looking out for a shark fin, divergence, last step broken and all that.
Yeah.
Then now you're talking about you're talking about Q zones. That's the times when we are likely to get setups to enter a trade.
Yeah.
How do you relate it with the shark, these other entry strategies? Is it that at this time, during this Q zone, we still need to look for the shark fins and all that, or we should just, because it's the Q zone, when at those times, we are most likely to get a trade, we shouldn't consider the divergence and all of that?
No. You have to consider you have to consider your entry. Remember, we are not in Forex to trade blindly. So part of our trading plan is, one, we have to identify the institutional order flow. number one. Number two, we look for what is price action doing at yesterday's high or yesterday low. All those conditions still have to be met. Then the third thing, we now look for confluences with the aid of TDI, shark fin divergence. Then we look for last step broken and the like. Let's take today, for instance. We had stated earlier that we would be looking for opportunities to sell the Euro USD, right? You know the institutional order flow is bearish. For you to sell Euro USD, you need to see a bearish breaker on your 15 minutes. So you are now on your chart today. You noticed that price was making some form of high, right? Then it started coming down. What was the last bearish candle before the highest high you can see on your chart? So go to insert, insert shapes. This was the last bearish candle. Can you see that? This candle that looks like a doji right here was the last bearish candle before the high that created the Asian high. Now, during the kill zone, price gave you a breaker here, right? So your entry for a sell actually is from this point. Notice how it coincides with your kill zone. So during your kill zone, you might have gotten the last step broken, for instance, during the Asian session, and you are having your retest during the kill zone. You know, but just to ensure you don't sit in front of your chart all day, else you would be in front of a chart in London, you'll be there in New York, you'll be there during the Asian range. And what's the reason of wanting to make money from Forex? Is to give us freedom, right? So we'll have to begin to develop the attitude that gives that freedom. So we could do this over and over. You have this day, we're looking for sells, right? We're looking for an opportunity to sell on the 13th of March, right? So you woke up, London session. You notice that during the Asian session, it's been giving us higher highs, swing high, swing low, swing high, swing low, swing high, swing low, and it gave this swing high, right? So when you came up, what you saw was just this point. Everything to the right of your screen and to the right of my cursor had not occurred. So what would you be looking out for? You know this is the highest point, and this is the recent low that gave us that high. You mark up that low. You simply mark up that low. You also would have your TDI, I believe. You would have your TDI on the 15 minutes based on our strategy, right? So if I magnify this a little, sorry, take this up a little, and this, you would notice that at exactly the point where you have your high, you have a shark fin here. Can you see the shark fin? Price went above the volatility band, right? So that's confluence. Shark fin gives you the confluence. Now you'll be waiting for a break. You're waiting for a breaker to be formed, right? Your condition one is known already. You're in a bearish order flow. Condition two, price around yesterday high or yesterday low. Price is above yesterday low. Yesterday low was this point here. Price has broken above yesterday low. Remember, why are we waiting for price to break above yesterday low? I'll quickly do a refresher on that. Is because we have discovered that if price is going to be in a downward trend, it behaves in a particular manner, right? So price is in a downward trend. It behaves in a particular manner. Once it's done selling for the day, it usually will retrace a little, open the next day, and sometimes could trade into the candle before dropping further, right? Notice once it dropped, then it retraced back into the day, closed beneath the low of the day, opened the next day, traded higher, and dropped, right? That is the nature of price. I think you need to watch part 2 of that series. So let's go back to this. Right, so you'll be waiting for a breaker. And when did you get the breaker? Let's magnify this a little so we could see more clearly. So this was our order block. Price closed beneath it here. So we'll have a breaker right about now. And everything here was a retest for a sell. 1, 2, 3, 4, 5 candles retesting for a sell. And all that happened when? During the London Q zone, right? So you were in for a sell. Your stop loss was 20 pips or thereabout. If your first take profit, like usually say, will be 1:2 if you decide to use that method. So 20 pips or thereabout to Asian high, that's about 17 pips, right? So your first take profit will be 34 pips, right? Still within the London Q zone, your first take profit was hit, right? You had another entry again within London Q zone, right about here. So you had another entry for a sell. If you are still in the market, if your trading plan still gives you opportunity to go in for a sell, you still could have gone in for a sell at this point here, either of this candle, and you held that trade for only God knows how long, right? But notice that the setup could have happened during the Asian session, and your entry triggers are coming on during the Q zone. And that is the interesting thing about this. I could do this over and over and over. Notice we're going bearish on the 12th. Price created high. And the high was above the low of yesterday. The low of yesterday will be somewhere around here. Right? Price was above the low of yesterday. Right? So we'll be expecting that if price is going to sell, then this point X here should be the high of the day. So we'll be waiting for high of the day to be created. If you are familiar with the high of the day and low of the day concept, we'll be waiting for the high of the day to be created. And how do we know that the high of the day has been created? When subsequent rallies do not take out that high. And how do we know that subsequent rallies will not take out that high? When we have a breaker. So which was the last bearish candle before the swing high? We have it right here. Shapes. This was the last bearish candle before the swing high. Remember, with the wick of the right, of the candle to the right. The wick of the candle to the right. And we have that there. Price played round your Q zone. Price was playing round. Then you had a breaker at the end of your Q zone. You simply set your sell limit. Price picked you up. Right? If you had the guts to take a walk, by the time you're coming back, you should be in some level of profit. Price pulled back, gave you another entry somewhere here and here. Should you have missed this, you had another entry during the New York Q zone and price dropped. So stop loss for this trade would have been about 70 pips. Your take profit should be twice that, which would be 140. Did this give us 140 pips? Oh yeah, it did. It surely gave us 140 pips. But notice we had to sit. So tomorrow, it's about the same time I'll be having this session again. I'll be looking at patience, the #1 winning strategy of a retail forex trader. Patience, waiting precisely for your entry triggers. Remember, before you arrived at the entry triggers, you would have done tons and loads of back testing, and you discovered, okay, this condition gives me an edge in the market. The ability to wait for that edge to present itself is what makes you a winning trader, right? So I've been able to explain with these 2 examples. I believe we've done enough for today. Let's see what happens tomorrow, 9:30 p.m. Nigerian time. Let's reconvene and dig deeper. I'm sorry we couldn't go into high of the day, low of the day concept. I'd wanted to explain it a little bit deeper so you could see the market from the eye of that concept. But I believe we'll cover that sometime within this week. So thank you guys for coming online. Have a
Thank you, sir.
nice night.